Okay, so guys, let us go ahead and take on this concept called adjusted present value. Now, this particular concept is really important from examination standpoint. And in case you wonder which chapter in your study mat has this concept, people should refer to your study mat chapter number 3 on advanced capital budgeting. That your study mat has given just one small paragraph on adjusted present value. But there was a question in November 2020 examination, I think around 8 to 10 marks on this particular concept. And even now in your study mat, there is a small para given about adjusted present value, and they might test this in the examination. Okay. And for you not to get completely perplexed or baffled in the examination hall, let me explain this concept. Let me throw some light on this concept called adjusted present value. Now let us first go through this question. You might get the same question in the examination as well. Please learn this sum really well. Let us go through the question. And then before we take on the solution, we'll make some notes on what exactly is adjusted present value, and then we shall proceed with the solution. Is that fine? Yes, Subhash, read the question for us.
GFC Limited is considering investing in a new equipment costing $30 lakhs.
That is $30 lakh. If you want to, is more of an Indo-American, right, way of telling.
Yeah.
Or you can say $3 million.
Okay.
That is $30 lakh or $3 million. Is your initial outlay. That is your company. Let's have it as our company, no? Our company is going to invest in a machine costing how much? $30 lakhs. People think, is this some on Forex? No. We are going to calculate the net present value in what? In dollars. Is that fine?
Yes, sir.
So, US $30 lakh is your initial outlay. Then read further.
The equipment is likely to provide a cash flow after taxes of $10 lakh per year for 6 years.
You saw that they given the CFAT, cash flows after tax. They are given the cash flows, you can earn rupees or rather dollar how much? 10 lakh. Okay. Or you can say $1 million, right?
Yeah.
10 lakh. For how many years?
6 years.
For 6 years. Is that fine?
Yeah.
You can earn $10 lakh each year for the next 6 years. That's your CFAT. Then read further.
The unlevered cost of equity capital of the company is 16%.
You know what is the meaning of unlevered cost of equity? That is supposed to be the cost of equity in case a firm did not employ debt. That is called the unlevered cost of equity. How much? 16%. It is 16% is the cost of equity that is unlevered. Next.
The company intends to finance the project with 60% debt, which will bear an interest of 12%.
Now tell me, what is 60% of $30 lakh, which is $18 lakh will be what? Debt. That means out of $30 lakh we are planning to invest, only $12 lakh comes from the shareholders. It's their money. And the balance $18 lakh is loan funds, right? So $18 lakh will be loan at what rate of interest?
12%.
At 12% rate of interest. Okay.
The loan will be repaid in equal annual principal payments at the end of each of the 6 years.
You saw that this $18 lakh will be repaid in 6 equal annual installments of principal. What is 18 lakh by 6?
3.
End of each year, you'll repay $3 lakhs. Or say $300,000 will be repaid end of each year in the next 6 years. Next.
Flotation costs on financing will be $1 lakh and the company
What is flotation cost? Issue cost. That is a loan processing fee, for example. How much?
1
To
lakh
raise that, that $1.8 million, nothing but $18 lakh, you have to incur how much? $1 lakh as your flotation cost. Nothing but the processing fee. Okay, then read further, sir.
And the company is in a 30% tax bracket.
Very important. The tax rate is how much? 30%. Then,
what is the adjusted present value of the project? Is the project acceptable?
Is it financially viable is a question. And you have been asked to calculate something called the adjusted present value. So how does it work? Now, before we can go ahead and take on the solution to this example, let me explain, okay, what are the, how do you go about calculating the adjusted present value? Guys, you just have to make a flow chart. Now, right in the center, APV, that is adjusted present value. Write that in the center.
So just a minute.
Yes.
Start.
Okay, so please go ahead and write this flow chart in your notebook. Right in the center, adjusted present value. And then you branch it off into two. On one side, you should write investment decision. What is that? Investment decision. And the second part you can write, it is a financing decision. It is investment decision and a financing decision. Okay?
Yes, sir.
Now listen to me. Now what I'm doing is I'm using something called the, this APV technique can also be, you can say in a fancy way, it's called the divide and conquer approach. What is that? Divide and conquer. That means I'm going to separate my investment decision from the financing decision. That means first I'll check whether it is worth investing in the project or not. For that purpose, what I will assume is, what if all the $30 lakh is equity financed? Is it worth investing in the project? Doesn't matter whether out of 30 lakh, 18 lakh is loan funds or not. Got it? Is it worth investing in the project? And then the second part, you do the financing side effects. Example what? Suppose you borrow money and invest in the project. There's something called tax
benefits,
savings or tax benefits on what? On the interest you pay on the loan. And that is a financing side effect. Therefore, please remember, under investment decision, you can drop an arrow down and write discount the CFAT, the cash flows after tax.
This is under investment.
Under investment decision, you can drop an arrow down and write, what is that? Discount CFAT, right?
Yes, sir.
At unlevered cost of equity. Using what? The unlevered cost of equity. Unlevered, you can write KE, cost of equity, right?
Yeah.
And when you discount the cash flows using the unlevered cost of equity, you get something called the base case NPV. What is that? Base, BASE hyphen case, net present value.
Yes, sir.
It's called base case, net present value. That's it. Now I repeat myself. It is under investment decision. Please discount the cash flows after tax using what? The unlevered cost of equity. And the number you get after discounting all the cash inflows and minus the initial outlay, you get something called the base case net present value. That means what? Is this project worth investing or not? Doesn't matter how it is financed. Got it? That is the first branch done. Now, what about the financing side effects? I'll introduce two side effects. There's one more. I'll introduce that in the next sum that I want to work out, the next video. But here I'll give two popular side effects. Under financing side effect, you can write number one is the issue cost. Nothing but the flotation cost of raising money is a financing side effect. Because had you not gone for the loan, what? You wouldn't have paid how much? $1 lakh. Yes or no? So that is a financing side effect. So $1 lakh is a finance, that's issue cost. Make a note, issue cost, that will do. You want to write 1 lakh, just write issue cost, that is the first side effect. But you can take the issue cost after considering the tax benefit, if any, right? And then the second side effect will be, this is a negative side, what way? It's a cash outflow, right? Issue cost. The second is a positive side effect. What is that? The tax savings on interest. It is a tax benefit or the tax savings on the interest. Okay, that is loan interest or debt interest. Is that fine?
Yes, sir.
So this is a positive side effect. Now these are the two parts. Now when you put these two together, which one? Your base case net present value and what? The financing side effects. You'll get what? The adjusted present value. If it is positive APV, accept. Negative, reject. You get it?
Okay, sir.
So that is the approach you're going to follow in this example. Now let us go ahead and take on the solution. Okay. Now, yes, Subhash, we can go ahead and write that on the screen and people can take down, right?
Yes, sir.
Now tell me how much CFAT each year? It is going to be $10 lakh, right?
Yeah.
Every year.
Yeah.
And have they given the discount factors at 16%?
Yes, sir.
As a part of the question?
12%.
They're given 12%.
Yeah.
And also 16%. They have
PVIF for 6 years.
6 years.
At 16% is equal to 3.68.
They given the annuity factor.
Yeah.
How much?
3.6847.
Which is nothing but the discount factor for 6 years at 16%. They given the annuity factor. What are you going to do? $10 lakh into how much? 3.6847 multiply. So how much you get? Around 36 lakh. It is 36 lakh.
36 lakh 85,000.
85?
Dollars.
85,000, right?
Yeah.
Okay. Minus the initial outlay. How much? $30 lakh you subtract. Is that fine? Now how much you get? It is $6,85,000. Or guys, if you want, you can place the numbers in millions. Is that fine? It is 1 million into the discount factor, the annuity factor, minus initial outlay 3 million is your base case net present value. How much you get? It is $6,85,000.
85,000. I'll write base case NPV.
This is called base case net present value. Please make a note, guys. You have to write this is called the base case net present value. It's positive, right?
Yes, sir.
Brilliant. No, it's worth investing.
Yeah.
It's going to get better only now. Because you're going to enjoy some tax benefits on the interest you're going to pay on the loan. So this is your base case net present value. But sometimes what happens, Subhash? The project will have a negative base case NP, but it will become positive when you take the financing side effects.
Okay.
Because of the tax benefits you're going to get on payment of interest. You get it?
Yes, sir.
But here even the base case is positive. Brilliant project. Now next, we have to now make a nice table to calculate the tax savings on the debt interest, and you got a present value that, because you're going to enjoy that over the next how many years? 6 years when you're going to pay interest, right?
Yeah.
So now let us make a nice table. The column heads are, what is that? Year. The second column will be the loan outstanding, and third column you can make interest on the loan outstanding that you're going to pay, right, end of each year. What is the fourth column? It is a tax savings on interest, or it's a tax shield, right? It is a tax savings on interest. Next column is a discount factor at what rate?
12%.
For APV purpose, what you can do? Since the debt is at 12% rate, you can use the same rate for discounting the tax benefits on the debt interest. Is that fine?
Yeah.
The same 12% can be used at 12%, discount factor at 12%. And what is the last column? It is a present value. Fine?
Yes, sir.
Shall we? Now please write under year, write 0. And second column, how much? 18 lakh is a loan outstanding. If people wonder how you got 18 lakh, nothing but $30 lakh initial outlay, that into 60% is how much? 18 lakh. That's a loan borrowed, 18 lakh. And that is all. In other columns, nothing. Now right under year 1, we come to the end of year, okay? What is year 0? Beginning of the year. Now year 1, out of 18 lakh, how much will be repaid? You'll repay how much? 3 lakh. Therefore, 15 lakh will be loan outstanding, no doubt. But remember, you are supposed to calculate the interest on $18 lakh. Yes or no?
Yes.
But that is a loan outstanding. That's a loan from the beginning of the year. You repaid $3 lakh only at the end of the year. So on $18 lakh, what is 12% interest? It will work out to $2 lakh and 16,000. Is that fine?
Yes.
2,16,000.
Yes, sir.
And then next column will be what? The discount factor, which is given in the question at 12%. 0.89. They're given 4 decimals or?
8928.
89. They're given 4 decimals in the question itself.
Yeah.
Remember guys, whenever the discount factors are given in the question, you just take those numbers. You do not Manufacture the numbers. Take the numbers given in the question. Okay, 0.8928. Maybe the discounted amount, no, that can be simplified, right?
Yeah.
And what is the tax savings on this 2,16,000? 30% of 2,16,000, how much? It is
0.648
or 64,800, or you can write in thousands. It's up to you. You're writing in thousands?
I have not mentioned it, sir.
You haven't mentioned. But let's write 64,000.
Okay.
It is 64,800. And you are writing 18 lakh, right?
Yeah.
Okay. So 64,800. But you written 2,16,000?
I have not, I have taken in lakhs only.
Lakhs. Okay. In lakhs. Okay. So that's fine. No issues at all. That's not an issue. Guys, even watch the video, don't get the thing. It doesn't matter. You're taking 2.16, right?
Yeah.
Okay, 2.16 lakh. And that into 0.8928. What is the amount? The last column?
It's 0.578.
Okay, then let's go to year 2 now. Let's go to year 2.
Yes, sir.
Year 2, what is the loan outstanding? Out of 15 lakh, another 3 lakh will be repaid. So 3 lakh.
12 lakh.
And so 12 lakh will be the balance. And interest will be for second year on 15 lakh, right?
Yeah.
On that, 12% is 1.8 lakh. And that into 30% tax saving, how much? Is 0.54 lakh. And into the discount factor given in the question, how much?
0.7972.
Very good. And then present value, how much?
0.431.
Okay. Then go to year 3. Another 3 lakh repaid. What is the balance now? Will be 9 lakh. Got it?
Yes.
And interest will be 12% on how much? On 12 lakh, which is 1.44. Is that fine?
Yes, sir.
And that into 0.3, 30% tax saving. How much is that?
432.
0.432 in lakhs, which is nothing but 43,200. Into the discount factor for year 3 as given in the question. Copy that and multiply and get the present value of the tax saving. Right?
Yes, sir.
You're done with year 3?
Yes, sir.
So let's go to year 4. Out of 9 lakh, another 3 lakh will be repaid. What is the balance? 6 lakh. And what is 12% on 9 lakh? 1.08. And what is 1.08 into 0.3? It is 0.324 in lakhs. And the discount factor you place. And then you get the present value. Got it?
Yes, sir.
And then let's go to year
5.
Out of 6 lakh, another 3 lakh will be repaid. So 3 lakh balance. And interest will be 12% on 6 lakh, 0.72. And on that 30%, how much you get?
0.216.
Okay, 0.216. And into the discount factor for year 5 and find the present value. Is that clear?
Yes, sir.
Okay. Then next.
6th year.
Year 6. It is 0. But interest will be on the 3 lakh, right?
Yeah.
Which is 0.36 in lakhs, 36,000 rupees interest.
Yeah.
And on that 30% tax saving, how much? It is 0.108. And that into the discount factor for year 6. How much?
0.5066.
And then get the present value. And you're supposed to total the last column. How much you get? The total of the last column. Only the present value of the positive side effect. The present value of the tax savings on debt interest, on the loan interest. How much?
1.7.
1.7 lakh. Nothing but 1,70,000 is the total amount of tax benefit on debt interest. 1.7 lakh, right? Make it as a positive financing side effect. Is that clear?
Okay, sir.
Now listen to me. By how much you got as base case NPV? I think we got 6.85, right?
Yes, sir.
We got 6,85,000 or 6.85 lakh. And here you got 1,70,000, or you can say 1.7 lakh is your positive side effect. Now let's go to, before we can calculate the APV, I will do one more calculation, Subhash. Just write down this, okay?
Yes, sir.
Now tell me, what is the issue cost?
1
lakh. 1 lakh, right? $1 lakh is the issue cost we saw.
Yeah.
That's an outflow, right?
Yes, sir.
But on this, you'll enjoy what? A 30% tax saving. The issue cost will also what? Nothing given, you want to enjoy some tax saving on issue cost. Unless they say in the question there's no tax savings on issue cost. So 1 lakh is a cash outflow, right?
Yes, sir.
Cash going out.
Yeah.
But on this, what is 30%?
0.3.
That is around 30,000 you will save.
Yeah.
So 1 lakh going out and 30,000 tax saved. Always remember, dollar saved is dollar earned. So what is 1 lakh outflow and 30,000 is a benefit? What is the net outflow?
0.7.
0.7 lakh or 70,000 rupees outflow. Now people should have discounted. No, why? Because this is outflow at time 0. This number need not be discounted. You can take it as it is. But remember, the 70,000 is an outflow. Is a negative side effect. Now let's finally find the APV. Please write, sir.
So why can't we include this in the table itself?
Which table?
Along with the loan outstanding, could we have taken this? Oh, we were
That 1 lakh.
Yeah.
No. We analyze each and every side effect separately.
Okay.
Now your doubt is, can't I subtract this 1 lakh from the loan I took? No, that is accounting will do that. But remember, under APV, I will consider each financing side effect separately. Got it?
Yes, sir.
Now let's write APV. What is that? Adjusted present value equals. Please write this formula first. Base case net present value. Write a base case net present value. Okay?
Yes, sir.
Plus the tax savings on debt interest. Okay?
Yeah.
Why plus? It's a positive financing side effect. Then minus issue cost. Minus issue cost net of tax. Why minus? It is a negative financing side effect, cash outflow, right?
Yeah.
This is your APV now. Now write a 6.85 lakh or 6,85,000, 6.85 lakh, then
plus 1.7
plus 1.7
minus
and minus 0.7 lakh, right? Net of tax outflow.
Yeah.
So 6.85 plus 1.7 minus 0.7 will work out to how much?
0.785 lakhs.
That is 7.7
7.85 lakhs.
85 lakh is your adjusted present value, which is what? Positive, right?
Yeah.
So you can green light the project. You can go ahead with the project. Please invest. Got it?
Yes,
Now,
sir.
guys, in case you have a doubt, sir, what about the loan repaid every year? 3 lakh as an outflow, right? And what about the interest I pay every year when that's an outflow, right? So don't bother. I'll tell you why. Now tell me, Subhash, when I say Subhash, it's all people watching the video also, right? Now tell me, end of year one, what is the cash outflow for the loan? You only repay 3 lakh and also pay how much interest? 2 lakh and 16,000, right?
Yeah.
In all, 5 lakh 16,000 outflow in the first year.
Yeah.
End of year two, another 3 lakh
plus 1.8.
Exactly, 1 lakh 80,000 interest. In all, 4 lakh 80,000, right?
Yeah.
Write down those numbers, Subhash. Year one outflow 5 lakh 16,000. Year two outflow, how much? It is 4 lakh 80,000. Okay. And year three outflow will be 3 lakh plus 1 lakh and 44,000. In all, 4 lakh and 44,000 outflow. Okay, sir?
Yes, sir.
And year four, it is 3 lakh and 1 lakh and 8,000, right?
Yeah.
In all, 4 lakh 8,000 outflow. Next year is going to be 3 lakh and 72,000.
Yeah.
In all, 3 lakh and 72,000, right?
Yeah.
And last year, it is 3 lakh and also what? 36,000 outflow. Am I right?
Yeah.
6 years done.
Yes, sir.
I repeat, 5 lakh 16,000 outflow, then
4 lakh 80,000.
4 lakh 80,000, 4 lakh and 8,000, 3 lakh and 4 lakh 44, right? 4
Yeah.
lakh 8,000,
Yeah.
and then 3 lakh and 72,000 and 3 lakh and 36,000. You written 6 numbers?
Yes, sir.
Okay. Now, if you guys discount all these numbers at a 12% rate of interest, you know how much you'll get? You'll get 18 lakh.
Yeah, correct.
You'll get 18 lakh. You try. If you don't trust me, you can try that. If you multiply the 5 lakh 16,000 year one and 4 lakh 80,000 year two, 4 lakh 44,000 year three, 4 lakh 8,000 year four, and then 3 lakh 72,000 year 5 and 3 lakh and 36,000 year 6. If you discount all these cash flows at 12% discount rate, you will get how much? 18 lakh. Remember, the 18 lakh was already subtracted as a part of 30 lakh to find the base case NPV. Yes? So why double count that 18 lakh?
Okay.
You saw the magic. In case you guys have any doubt, you can contact me after examination. Fine. But just see, that is the magic. That 18 lakh, the present value of all these numbers will be rupees 18 lakh, which is already subtracted to find the base case NPV. Remember, we subtracted 30 lakh.
Yeah.
Therefore, don't bother. Okay, but don't get confused. To find the base case NPV, I will assume that the project is all equity financed. I'll use the unlevered cost of equity and minus the initial outlay. Doesn't matter whether loan funds, own funds, doesn't matter. Loan funds or own funds, doesn't matter. You minus $30 lakh initial outlay to find the base case net present value. And then you consider the side effects. Now, this method is called, also known as what? The divide and conquer, because we have what? Divided the investment decision from what? From the financing decision, and still we are able to conquer, in the sense we are able to achieve the same objective to decide whether to accept the project or not. Is that clear?
Yes, sir.
Now, in case people have a doubt, what is the difference between this approach and the normal net present value? Had I worked out the same example, Subhash, on the normal net present value technique, I would have discounted the $10 lakh, right? Cash inflow, CFAT,
Yeah.
using, make a note, WACC. What is that? Weighted average cost of capital. I would have used that to discount. I'll get the same number net present value. Understood? But instead of using that approach, this approach is best suited, when, Subhash? Whenever you have these side effects. What is that? Issue cost. Can be well factored in the calculation separately.
Okay.
Got it?
Yes.
So please learn this for the examination. Okay. Good luck, guys. Bye-bye.